On Business Incorporated today. The European Union Global Gateway to support digitalization and digital trade in Tanzania. In Kenya, Power reports full-year profit as cost of electricity soars. South Africa's Eskom suspends power cuts scheduled for the weekend. Hello and welcome to the program. I'm Will Ibang. Let's begin with markets in Africa, where sentiments are negative at intraday. We see Nigeria's NGX tumbled 2.10%, while South Africa fell 1.41%. Elsewhere, Egypt's EGX30 closed trading for the week on Thursday in positive territory, while Kenya closed also in the green yesterday, 0.7%. Now, in the Middle East, the major equities were closed on Thursday, except in the UAE, where the Abu Dhabi and Dubai indexes were down 0.6 and 0.76% each at intraday. Meanwhile, Saudi Arabia and the Qatari indexes closed trading on Thursday in opposite directions. Now, we'll move over to the EU, where Volkswagen has reported lower profits in the latest quarter after taking a 1.6 billion euro hit due to its suspension of production in Russia. But Europe's largest car maker is still optimistic about the months ahead, even as an economic downturn looms. And Stephen Beardsley joins me from Deutsche Welle in Berlin to tell us the details about this. Stephen, how detrimental has the war in Ukraine been for Volkswagen?
Yeah, Volkswagen reporting earnings of 4.3 billion euros for the third quarter. That's down below pre-pandemic levels. And a lot of that is on this 1.6 billion euros that it said the results of the war in Ukraine, especially stopped production in Russia, has led to. Now, Volkswagen, I should say, did stop that production in its Russian market at the beginning of the war, but that's still a money pit for them. It said that overall, the overall effects of the war in Ukraine cost them 2 billion euros during the quarter, and that could be taken to mean whether it's production delays, changed delivery routes, things like that are a consequence of the war. So this is still a big problem for them going forward. And Volkswagen has indicated that it's willing to sell elements of its business in Russia. It hasn't said exactly what, but obviously this is a problem that could be a long-term one given the duration of this war.
Stephen, revenues have been rising. How optimistic can we say Volkswagen is since the economic downturn is continuing to worsen in Europe?
Yeah, rising revenues is one of several positive signs that this report includes. Another is that there were strong commercial vehicle sales, for example, up 31% in the quarter, but also that Volkswagen's business in China actually did quite well. That is a very good sign considering the state of the economy there and the significance of that market for Volkswagen. At the same time, there are very concerning signs about the state of the economy here in Europe and across the globe. That could be affected in the months ahead as, for example, if there are more COVID lockdowns in China, that we've seen that depress consumer sentiment there. We know that further restrictions could also affect European markets, North American markets. But in both of those markets, there's also going to be the concern of recession and the concern here in Europe of rising energy costs and what that means for consumer sentiment. There's widely expected to be a recession next year, and we're sort of heading that way. We're seeing activity fall as this year closes out. In fact, Volkswagen saying that they expect deliveries this year to do no better than 2021, a year still affected by the pandemic. So it says that it expects to see them fall off slightly in Europe and North America, but to improve slightly in China, or in Asia, I should say. So all of that is still subject to what happens in the coming months, especially with those lockdowns in China, something that Volkswagen and many car makers, many manufacturers here in Europe will really be watching.
Stephen, we'll continue to watch and see. So the economy is really hitting bad, and we see the ECB also hiking rates by 75 basis points. Now, what are we seeing from European markets today?
Well, let's start with Volkswagen. It was actually down more than 2%. I think investors were disappointed by that delivery number, the prognosis that Volkswagen had, despite confirming its prognosis for the entire year, that addition that deliveries would not improve from 2021, leading to some people dumping that stock. Overall, indexes were down across Europe. The stock 600, that's the Europe-wide, the pan-European benchmark, also down, led by technology shares. Those shares likely feeling the weight of a not-so-rosy outlook posted by Amazon in its latest quarterly report. That helped drag Wall Street down as well. Europe feeling the effects of that too. Also some concern there among investors about the expanding COVID lockdowns in China, which I just mentioned. More signs that that is ramping up as temperatures start to get colder, and that, of course, could depress manufacturing ability there as well as consumer sentiment that has a great ripple effect here in Europe.
Thanks, Stephen, for the updates. We'll keep watching track of that. Thanks so much, Stephen Beasley from Berlin. Now we lean forward to the UK, where Juliana is standing by to keep us updated with the happenings there. Happy to have you, Juliana. Good to speak to you.
Nice to see you, Will.
Now, we see Elon Musk has closed the $44 billion Twitter takeover, and he's fired top executives. Now, do you think this move of his is indicative that he will not play by country rules?
Well, that's a difficult question, and I think, you know, if we just look back at the timeline of how Elon Musk, the world's wealthiest man, has come to be the owner of Twitter, then you can say that, you know, the future is likely to be unpredictable. We first heard about his intentions to buy the platform in April for that $44 billion, which I think most people would say is well overpriced. And then in May, I believe he got cold feet because he said it was on pause. He wasn't convinced with the numbers that the former execs gave him about bots on the platform, which is a major issue. And then he said he was pulling out. They said, you're not pulling out. We were expecting to have this big showdown in court. And then just a couple of weeks before the court hearing was due to start, we now know that Elon Musk is going to be the owner. As you said, there have already been some high-profile sackings, including the CEO, Parag Agrawal. You know, he has said quite clearly that he wants Twitter to be a kind of online town square where people can feel free to express their feelings without being cancelled by the lefty woke mob. He has said that he wants to invite the former US President Donald Trump back on the platform. You know, there are going to be concerns. I think it's fair to say that Elon Musk is pretty popular. He's managed to amass about 110 million Twitter followers. I would take even 1,000 of those from him. And so people do like him, but do people want him to run the platform? I'm not too sure about that. Especially in the UK, we have had, Will, some pretty high-profile cases of very young children who have led to self-harming, even suicide, because of the kind of content that they've been seeing online. So on the one hand, I think people are like, yes, it's good, let's have free speech. But on the other hand, it's kind of like, how far can you go when we know that content can be quite harmful? So I'm sure the EU, as well as Britain and the National Security Agency, who I think are even looking into this deal, will be following, you know, his overview very, very carefully to make sure that it does stick with rules.
Yeah, definitely. We do love free speech, but there has to be some kind of restraint or constraint to how we express them. You know, so Elon Musk is better just, you know, probably play by the rules right now, Juliana. If not, he's not probably going to make a lot of money from Twitter, and the governments are not going to back him up, and he definitely needs the support of the governments to be able to carry on as it is. So we also see that International Airlines Group has posted their third quarter revenue, and they exceeded pre-pandemic levels. But tell me, it's quite surprising. How did they manage that despite the capacity restrictions we've been seeing at London Heathrow? We've seen no cuts in flights, and they managed to beat pre-pandemic levels. How did they do that, Juliana?
Well, the short answer is high ticket sales. I think if you look at anyone, Will, that's traveling at the moment, you know, it's eye-watering. It's very expensive to travel. I think airline ticket prices have gone up about 22%, and that's been cited by bosses at International Consolidated Airlines Group, IAG. That's the parent owner of British Airways, as well as the Spanish airline Iberia, the Irish airline Aer Lingus, and Vueling too. And you know, it's been pretty decent for them. I believe they've managed to post revenues of about 1.2 billion euros within that peak summer period. That peak, the third quarter is really peak for airline industry bosses, because we know most people travel during the summer. And it has been difficult, as you said. Heathrow, one of those massive airports that had to put a cap in place, 100,000 passengers a day, because they just didn't have the staff to look after the passengers. But they still managed, you know, to make those profits. And that compares to, if you look back this time last year, IAG reported losses of about 422 million euros. So they're definitely back on track. But as we know, there is still a long way to go. We were hearing from John Holland-Kaye, the Heathrow boss, earlier in the week, when they posted their updates. And, you know, they're not expecting pre-pandemic numbers to come back until 2025, 2026. And mostly that's due to the cost of living crisis. It is just very expensive to travel. So whereas before the pandemic, people would take short haul trips across the continent, people are not really doing that now. You know, they're really careful with how they're spending the money, but still really good a profit update from IAG.
Juliana, we just hope that the good fortune from the airline, as the IAG, will rub off on the tech space. We're seeing Amazon, Meta trembling in their Q3 reports, and Zuckerberg saying we should be patient. I just hope the good fortune rubs off, because the tech space is not just having it good at the moment. But our other markets looking at intraday, Juliana?
Markets are not great. It looks like we're going to be heading into the weekend in the red, pretty similar to where we were this time last week, although the only thing is now at least we've got a prime minister. So all that market turmoil we saw earlier in the month has kind of ceased. We had that trading update, didn't we, from NatWest, which, even though it was positive, it's kind of been dragged down due to the fact that they are foreseeing people not paying back their loans because of higher borrowing costs. But at intraday, the FTSE All-Share is down 0.67%. The FTSE 100 is down by 0.5%. And the FTSE 250, the domestic market, that's down by triple-digit figures, 1.10%. The pound is still rallying against the dollar, but dipped a little bit at intraday. At the moment, £1 will buy you $1.15, just above that, which is great compared to where we were pre-Rishi Sunak. The British pound is trading down against the euro by 0.13%, but trading up against the Japanese yen at intraday, by 0.64%.
Juliana, it's not good to be the bearer of bad news, but thank you for telling us the markets, and we're hoping that it picks up, and good to see you relax at home.
Well, the kids are hiding under the table. They're not very relaxed. So thank you, Will.
No worries, Juliana. Thanks. And now we'll move over to Asia, where Hong Kong stocks plunged to its lowest level since April 2009, leading losses in the Asia-Pacific as the Bank of Japan left its benchmark interest rates unchanged. The Hang Seng Tech Index, lost 4% in the final hour of trade, dragged by the Hang Seng Tech Index, which fell by 6.2%. In Australia, we see the S&P ASX 200 down 0.87%. The Nikkei 225 in Japan fell 0.88%. The Topix index is also down. The Kospi index is down 0.89%. The Shanghai Composite also down 2.25%. All markets in Asia speak in red lines at the moment, and we're hoping the market picks up by next week. Now we move over to the U.S., where NASDAQ 100 futures were lower early on Friday after disappointing Amazon earnings added to the already pressured index. Futures tied to the NASDAQ dropped 1.09%. Dow Jones Industrial Average futures were slightly lower, and S&P 500 futures lost 0.64%. Amazon led the declines in extended trading, having plunged after the company posted weaker than expected quarterly revenue and issued disappointing fourth quarter sales guidance. Apple shares were initially lower too after the company reported weaker than anticipated iPhone revenue, but they have since reversed higher. The company still beat Wall Street's estimate for quarterly earnings and revenue. Next, more stories from the African continent. Do stay with us. This is right after the break. This is Business Incorporated. Welcome back. Now we look at some key elements in South Africa's budget, which was presented on Wednesday, and we saw that the budget was revised. We saw a revised economic growth, cutting budget deficit, and addressing the electricity power issues. Crime and corruption were one of the key highlights of the midterm budget in South Africa. Now, Matt Kindiger, practice leader, Sub-Saharan Africa Frontier View, provides more insights as to what this means for the economy and what these cuts also mean for the general public. Matt, it's good to speak to you today.
Hi, thanks for having me on the program today.
Now, so what does the budget, we saw what the minister did on Wednesday, but what does the budget mean for the government's spending and investment plans?
Yeah, so I would say actually the budget speech on Wednesday is mildly positive for investment and spending over the next couple of years or so. And this is because the government has quite significant breathing space as a result of much stronger revenues than it previously anticipated. And this is a direct result of higher tax revenues from commodities. So we know commodity prices are very high at the moment. South Africa is a major commodity producer, so it's directed, it has benefited public finances directly. What this means for investment and spending plans, so we are going to see slightly better than previously expected spending increases, budget allocations for functions and departments such as education, healthcare, law enforcement, but also infrastructure projects, especially road and rail infrastructure projects. So we're going to see probably, better annual increases for budget allocations for those departments. But I would emphasize it's not going to be a spending bonanza for government departments. The government is still expected to face, the budget deficit is still expected to average about 5% of GDP this year and next year, and public debt as a percentage of GDP is probably going to peak at about 72% next year. So even though revenues are relatively upbeat, the government is still under quite a lot of pressure to cut its budget deficit and stabilize public finances over the course of the year. So we're not going to see massive spending increases in our view.
Well, we saw in the budget presentation that they mentioned that they made some sort of bailout for Eskom. Does this mean that Eskom will no longer have problems? Because we're seeing that they're still planning to have power cuts. But this money that the government is going to hand out to them, how does that help Eskom in the near term?
Yeah, so it certainly is a major lifeline for Eskom. So Eskom's debts are estimated, well, were estimated to be about 10% of total public debt in South Africa. So what the government has decided to do is to take up to 2/3 of Eskom's debt and put it onto the government's budget balance sheet. What this means is that Eskom will have a lot more capacity to invest in improving infrastructure, spend more money on maintenance, hire more skilled staff, procure very expensive coal at the moment. So certainly it will help Eskom's performance in the short to medium term, but it's certainly not going to solve all the problems that the country is facing from a power shortages perspective. It's very clear that South Africa still has a very large power deficit, and by the president's own admission just a couple of months ago, he expects load shedding to continue well into 2024. So certainly a positive move for Eskom, but it won't solve the power shortages at the moment that the country is facing.
How will households, individuals be able to, how would they be affected by this budget? How would they be?
Yes, certainly. So this is a very important question because there was quite a lot of anxiety that the government was going to be increasing income taxes, payroll taxes, and also cutting social benefits because of squeezed public finances over the last couple of years. But two major benefits households will see two major benefits. One is high income households will benefit from the government's decision not to increase income taxes nor introduce any new payroll taxes over the next couple of years. So this is very important because there's a very large, wealthy, high-income household segment in South Africa, and they're very important for consumer spending. The other is the lowest income households will benefit from the government's decision to extend the social relief grant payments of 350 Rand per month over the next year. This was first introduced during COVID, but the government has decided to extend this. This provides a lifeline for the lowest income households. But the middle-income household groups are probably going to be the worst off, and this is because many middle-income households rely on the public sector as their main source of employment, and the government has decided to raise incomes or civil servant wages by only 3% this year. And this is far below inflation, which is running closer to 8 or 9%. So we're going to see middle-income households, especially those that rely on civil servant jobs, to be squeezed over the next year or so. So on balance, relatively positive, although there are some households that may find that their incomes are a bit more squeezed.
Thanks so much, Matt. Thanks for. I hope you keep tracking what's happening in South Africa. As I mentioned earlier, Eskom has planned to suspend power cuts for the weekend due to lower demand of electricity, and we'll see how that pans out, if they continue with that or if it remains permanently suspended. Thank you so much, Matt Kindiger, practice leader, Sub-Saharan Africa Frontier View, for sharing your thoughts with us today.
Thanks, my pleasure.
Now, Eskom has suspended power cuts scheduled for the weekend due to a lower demand of electricity. That's in South Africa. The power utility said it would suspend the scheduled power cuts at midnight. Eskom said it will resume with the scheduled power cuts again from 5 a.m. on Monday, starting off the week with stage 2 power cuts. Now move over to Tanzania, where the European Union has officially launched a new project under the Digital Tanzania program, Tanzania Inclusive Digital Economy, tied in partnership with UNDCF. The EU is rolling out its global gateway, among other actions, to support the digital agenda of the government of Tanzania to connect goods, people and services to the benefit of all Tanzanians. In March 2022, Tanzania's Ministry of Finance and Planning, the European Union to Tanzania signed the EU-funded financing agreement for the EU Digital for Tanzania program to support the digital sector for a total amount of 35 million euros. The program will empower Tanzanian women and girls by promoting their rights and unlocking their strong potential to boost the Tanzanian economy. Now move over to the Kenyan sector, power sector, where Kenya has recorded double its full-year profits. The electricity distributor registered a profit growth of 133% to 3.5 billion Kenyan shillings from the 1.5 billion Kenyan shillings it recorded during a similar period in June 2021. In a statement issued on its social media pages, Kenya Power says the growth in profit was driven by a 6.9% increase in sales and an improvement of 1.5% in system efficiency to 77.57% due to sustained war on energy losses. And that's it on Business Incorporated. Do join us next week for another edition. Bye for now. I'm Willie Bang.